Hello guys, welcome to today's class. We are doing change in accounting policy today. So for those of you who are new, I'm Faiz Khan. I run Eduhans. Eduhans provides online courses for third years and CTA students. For us, like the whole purpose here is to ultimately, the core purpose is to be a place of hope, a place of optimism, and in doing so, to ultimately unlock your potential. So all of us have potential that is most likely hidden. So it just needs to be unlocked. And the way we do that basically is just simply simplifying large complex content and helping you develop a way of thinking so that you are able to handle any question that comes your way. So that is basically what Eduhans basically does. So part of that is to provide these free master classes where we provide it on a Saturday between 11 and 12. Not every Saturday, but most Saturdays. So today is basically the second Saturday. We had a deferred tax class previously, and now we're doing change in accounting policy. We most likely have the last class next week, Saturday, before test one, and then test one for CTA students. We will take a break. We'll come back again. So yeah, so we're going to go in and we're going to do we're going to do a change in accounting policy. I'm using the same question that we used for deferred tax. So I'm only going to focus on that one additional information, which is additional information number 3 from that question we used in the deferred tax class called Measure LTD. So the way we're going to structure this class, I'm going to spend about 10 minutes just quickly doing a high-level overview, understanding of a change in accounting policies, and then we will attempt to answer that question. And as we answer the question, I will reiterate the important principles. So as we make mention, this class is change in accounting policies. Change in accounting policy. Change in accounting policy is dealt with under IAS 8. Okay, so International Accounting Standards number 8. Now, IAS 8 deals with change in accounting policies, correction of errors, and change in estimates. So it deals with those 3 things. Over and above that, it also handles, it also provides a guidance on how to come up with an accounting policy. Okay, so it has a hierarchy of explaining how you must come up with an accounting policy if the accounting standards do not have an accounting policy explicitly for a transaction. So that is basically what IAS 8 deals with. I will be dealing just with a change in accounting policy aspect. Okay. So just briefly, so you need to just understand what is a change in accounting policy and when can you apply a change in accounting policy. Remember, there are 2 situations where you can apply a change in accounting policy. Either it is a mandatory change or it is a voluntary change. Now, a mandatory change in accounting policy means you must change the accounting policy. And typically that happens when a new accounting standard comes out. So for example, before IFRS 15 came out, the standard on a revenue, the main standard on a revenue was IAS 18. There was many revenue standards, but the main revenue standard was IAS 18. So when IFRS 15 came out, it was a mandatory change in accounting policy to go from IAS 18 to IFRS 15, and companies had to apply change in accounting policies. Now, that was quite a complex situation. So IFRS 15 provided some leeway in how to make the change a lot easier. But we're not going to go into detail with that. Similarly, when IFRS 9 came out, before IFRS 9, the standard was IAS 39. So when IFRS 9 was in play, it was a mandatory change from IAS 39 to IFRS 9. Similarly to that of IFRS 15, that change in accounting policy was significant. It was huge. And as a result, IFRS 9 provides some leeway or some, I don't want to call it leeway. You still had to apply a change in accounting policy, but they made it a lot more easier and the companies could opt to do that. I worked for financial services companies as a financial accountant previously. So for financial services, IFRS 9 is huge. They basically 3 years before IFRS 9 came into play, because obviously they tell you IFRS 9 is coming into play on a certain date. Literally 3 years before that, these financial services, they got audit firms to actually help them with that implementation, because there's lots of calculations and lots of stuff that happens when you have this kind of change. So change in accounting policies is big in the real world when it does happen. So that is mandatory change in accounting policy. A voluntary change in accounting policy can only take place if you believe that it reflects a transaction better. Okay, so management would have to be able to justify why they want to do a voluntary change in accounting policy. A voluntary change in accounting policy is only applicable if there is a justified reason. So for example, if they believe that the new accounting policy will better reflect economic transactions. The reason for this is that if a voluntary change in accounting policy could just happen, then companies would change policies left, right, and center just to boost profits. Remember, the whole purpose of financial reporting is to provide users with financial information that is useful for decision making. So if change in accounting policies was easy to do, it wouldn't provide useful information to users, because management would literally change accounting policies almost every year just to represent a better profit. And that is why the voluntary change is not easy to do. Okay, you have to be able to justify. So that is basically when a change in accounting policy comes into play, mandatory or voluntary. Like we said, for voluntary, there must be a justified reason for it. So that is when to apply a change in accounting policy. Now the question is, how do you apply a change in accounting policy? So the way you apply a change in accounting policy, IAS 8 says a change in accounting policy has to be applied retrospectively. So retrospectively means you need to go back in time. So you need to change prior financials, okay? Now, you can't go back into 2018 physically, right? Once time has passed, time has passed. We haven't yet developed a mechanism to go back in time. We don't have a time machine yet. However, from an accounting perspective, the way we go back in time is to change the current financials. So remember, a set of financial statements includes the current period and includes a prior period, okay? So in the current set of financial statements, the current period will obviously represent the new accounting policy, but the prior period will have to be changed in order to represent the new accounting policy. So just take note of that. So the way to think about it, when you pick, if a company, let's just say Pick n Pay has a change in accounting policy, and it's happening in the 22 financial year. When you Google search Pick n Pay annual report 2021, and you look at their financial statements, the 2021 will remain 2021. But usually 2021 of last year would be the same in the current year financial statements in the prior year column. But when there's a change in accounting policy, when you compare the 2021 financial statements to the 2022 financial statements, you would see the prior year period would be different to the 2021 financial statements. So just take note, the prior period will change, but the prior period changes in the current financial year. Okay, so just take note of that. So you must be able to understand that, okay? just to so that you can so you make sense. Now remember, when you change prior periods, you can't change the actual income, you can't change the actual expense. The reason being is that the prior period's income and expense has been closed off to retained earnings. So when you adjust prior periods, you must take note that the adjustment will be against opening retained earnings. So this is extremely, extremely important, especially for the CTA students. Remember, in test 1, you're going to cover for test 1, fact 4861, fact 4863. Your topics is conceptual framework, presentation of financial statements, inventory, deferred tax, and then IAS 8. Okay, for CTA 2, it's also fair value. Now, if there's a change in accounting policy, you would have a change in opening retained earnings. As a result, that would have an impact on deferred tax. Now remember, an impact on deferred tax can go in one of three places, either through profit or loss, or through OCI, or directly through equity. Now remember, the deferred tax will follow the underlying transaction. So if the underlying transaction goes through profit or loss, the deferred tax consequence will also go through profit or loss. If the underlying transaction goes through OCI, the deferred tax consequence will also go through OCI. Similarly, if the underlying transaction goes directly through equity, such like retained earnings, then the deferred tax also goes directly through equity. Please, please, please make sure you keep that in whenever you do deferred tax. Make sure you ask yourself, where must this transaction go? Usually one will go to SFP, either asset or liability, and the other side, not all the time, but usually the other side would either go to P&L, OCI, or directly through equity. Make sure you keep your head straight when you're thinking of deferred tax in terms of where the other side goes. Okay, so that's very important. Just as a sideline, I know you have some CTA students here as well, and since we did cover deferred tax previously, with a change in estimate, that will also have an impact on deferred tax. And as a result, if deferred, so you need to have a look where, which, the tax rate have changed from 28 to 27. So opening deferred tax will have to change. It must now represent 27% and not 28%. So 1% change, you need to ask yourself, must the 1% change go, must all of that go to profit or loss? Does some go to profit or loss, some to OCI? Does some go to profit or loss, OCI, and directly through equity? So just make sure you are able to handle those type of changes. Okay. So just keep that in mind. So that is basically change in accounting policy. Simply knowing when it takes place and simply knowing how to account for it. So how do you account for a change in accounting policy? A change in accounting policy is applied retrospectively, meaning we need to go back in time and we need to change the financials of prior periods as if the new accounting policy have always been applied. So just keep that in mind, okay? Now, just to give a 1 minute on the others, so with correction of an error, a correction of an error is also applied retrospectively, meaning you must go back in time. So, and then a change in estimate is applied prospectively. So change in accounting policy and correction of an error is applied retrospectively. You go back in time. You change the numbers as if there was never an error, as if the new accounting policy have always applied. With a change in estimate, change in estimate is applied prospectively, meaning you will only apply the change in estimate in the current year and future periods. You don't go back in time. Okay, so just keep that in mind. So now I'm going to switch over into the question. And then you'll see what I mean by all of these stuff. So this was the question that we covered last time. Okay, so it was measure client to measure LTD. I'm only going to deal with number 3. Okay, so I'll only deal with number 3. You see. Okay, share in the Zoom group chat, whatever, in the Zoom chat. So you should be able to see it now. Okay. Okay, so let's go into this. So they say after profit in note 1 was calculated, the directors decided to change the accounting policy. So after the profit was calculated, then they decided to change the accounting policy, meaning the change have not been accounted for. Okay, so the change in accounting policy of the company in respect of the valuation of inventories. Previously, the company valued inventories on the weighted average method and changed the policy to the first in, first out method, since it will result in more relevant and reliable presentation. Okay, so this is a valid voluntary for voluntary change in accounting policy. This is a valid reason. Okay, presentation of the effect of inflation on the company's inventory balance. The inventory values at the end of February, based on the 2 methods of valuation, were as follows. Now, before we get into the numbers, understand what we're trying to achieve. We basically want to show inventory in the current year and in the prior periods as if the newer policy have always been applied. So what's the new policy? FIFO is the new policy. So we want the 2017 to always represent that. We want 2018 to have always represented that, and then 2019 would be that. Okay, but currently inventory is that in 2017, and currently inventory is that in 2018. So the question is, what do we have to do in the current period? What do we have to do in 2019 to ensure that inventory was always accounted for on the FIFO method and so forth? Okay, so that's the one aspect. The second aspect, what goes hand in hand with inventory, is cost of sales. So remember the formula for cost of sales. Cost of sales equal opening inventory plus purchases minus closing inventory. So therefore, In prior periods, cost of sales was using these balances when using opening and closing inventory. But we need to now change so that it represents these numbers for opening and closing inventory. So ultimately, that's what we're trying to do, ensure that cost of sales represents FIFO and not WAC, and that inventory represents FIFO and not WAC. Please what? It is shared in the, you should be able to see it in the chat. So I don't know if it shows, if you're watching on your mobile, I don't know if the PDF will show there, but if you're watching from your laptop, it definitely will be there. So now I'm going to switch over in. So here we can see those are the numbers, and then they will see, assume that SARS will not reopen the previous year's assessments for the change in valuation method. So remember why that's important. I would explain it again. I explained this in when we did deferred tax. I will explain it again. So remember, deferred tax arise due to a difference in treatment between accounting and SARS. So ultimately, what SARS is going to grant as a reduction and what accounting want to expense will be the same. But when the reductions and when the expenses are processed, that differs. Now, that gives rise to a deferred tax balance. When there's a temporary difference, that gives rise to a deferred tax balance. Now, when it comes to inventory, there's generally no deferred tax implication for inventory. And the reason being is that the way SARS values inventory, it is the same way that it is valued on the same basis as that of accounting. So if you read Income Tax Act, Section 22 of the Income Tax Act, then somehow you will figure out that SARS says that, or the Income Tax Act says that inventory will be valued on the same basis as that of accounting. So therefore, in 2017, when we're using the WAC method, SARS valued inventory as that, accounting also valued inventory as that, and as a result, there was no temporary difference. In the 2018 financial year, SARS valued inventory on that, and accounting also valued inventory on this, so therefore there was no temporary difference. In the 2019 financial year, accounting is valuing inventory as that for the 2019 financial year. SARS will also value it on that. So once again, there is no temporary difference. However, because the change in accounting policy happened in the 2019 financial year, in the 2019 financial year, the prior periods will have to change. So now accounting is valuing inventory at 1,440. But according to this line item over here, SARS is not going to reopen. So therefore, SARS is still valuing at 1,370. So that would cause a temporary difference because SARS's balance is still 1,370, but now accounting is 1,440. So that causes a difference, and the difference is of a temporary nature, and therefore it will be a deferred tax consequence. Okay, so just take note of that. So now I'm going to set up a format. You will see the format is basically the same, whether the way UNISA does it, the way UCT does it, UWC does it, basically all the universities do it kind of the same. This is probably just the easiest way of doing the calculation. So I will show you how to do the calculation, and then I'll show you how to use the information from the calculation to prepare the note. Remember, the calculation has the full note. It is just that you need to know how to take the numbers from the calculation and prepare the note disclosure. So let's go back in. I'm going to switch now over into Excel. If SARS opens, what you call, there will be no deferred tax implication. Okay, so if SARS opens, there will be no deferred tax implication, but there will be a current tax implication. So that means you must resubmit your current tax calculation. So there will still be a tax implication, but the tax implication would be for current tax. The fact that SARS do not open means that whatever your current tax was will remain the same, but now it will just cause a deferred tax implication. Okay, so you should be able to see Google Sheets. So basically what we want to remember, what we're trying to achieve. We're trying to achieve what impact does the change in accounting policy have on two things or three things. One, the balance sheet, and then number two, equity balance, and number three, the profit or loss. Okay, so the income statement and the balance sheet and the statement in changes in equity. So, or the equity balance, not the statement in equity, the equity balance. So that is basically what we're trying to do. So as I do the calculation, I'll just explain what I am doing, and then from there you can tell me, you can ask me any question. So I'm going to set this up. We start off with the new accounting policy. The new accounting policy is FIFO. You start off with the new accounting policy. Then we'll do the old accounting policy, which is WAC. Okay, so the year that it changed, the current year, 2019, we keep a gap. That will be the profit or loss, the impact on profit or loss. Then we'll have 2018, and then we'll again the impact on profit or loss, and then we will have 2017. Technically speaking, you must go back in time, meaning from the time the company used WAC up until the current year. So if a company opened in 1990, you should be going back to 1990. Okay. However, in that is technically speaking. Okay, so or speaking theoretically, but in what we do practically, you just go back 2 years. So you take current year and you go back 2 years. The reason being is the change is only happening in the current financial year, right? So the current financial year shows the current financials as well as the prior financials. So therefore, we only change the prior financials. The reason being is that is all that the current set of financial statements are showing. If your financial statements show 2 prior periods, then you will go back to 2016 as well. But most companies only show current year and prior year. So therefore, we're only going to change 2018's financials. We're not going to change all the years before. We only change 2018. Because remember, we're not physically going back and changing 2018's set of financial statements or 2017's set of financial statements. We're only changing the 2018 numbers that would appear in the 2019 financial statements. So just take note of that. Now, 2018 would then capture the change from the beginning of time up until 2018. So therefore, we only go back 2 years. We in the current year, we go back 2 years, 2018 and 2019. So just take note of that. But in theory, we should be going back all the way back. Okay, so just take note of that. So the balance that they gave us for 2019, I can't now remember what it was. 1490 and 1413. Okay, so 1490, 600, and then 1413. In 2020, what was it? 2018, 1440 and 1370. 1440 and 1370. In 2017, it was 1369 and 1312. 1369 and 1312. You can, I'll give you my number, then you can message me, then I'll send it to you. So now let's have a look what we're going to do. So now remember, in 2019, we want it to be 1490. But currently it is at 1413. So what's happening to inventory? Inventory is currently at 1413. We want inventory now to be at 1490. So what's happening to inventory? Inventory is going to increase by the difference. So inventory is going to increase by the difference. Okay. So what's happening? Inventory is currently at 1413. We want inventory to go to 1490. So what's going to happen? We're going to increase inventory by 77,600. Similarly over here, same story. Inventory in 2018 is at 1370. So if I go and search, let's just say this is Pick n Pay. So if I go search Pick n Pay annual financial statements 2018, I'm going to see 1370. So when I look at 2019, I would expect in 2019 financial statements to also see 1370 when I look at the 2018 column. But given the scenario, if I search 2019, I'm not going to see 1370 in the 2018 column. I'm going to see 1440. So someone that, let's say someone that researched thoroughly, they will pick that up. Then they would want an explanation as to why there's a change. And that is what the change in accounting policy note would do. Okay. So currently, inventory is at 1370. We have to go back in time because there's a change in accounting policy. So therefore, there's going to be an increase in inventory of 70,000. And the same story for 2017. 2017 is showing a 1312, but we want it to be 1369. So what's the impact on inventory? Inventory is going to increase by 77,600 and an increase by 70,000. Okay, we're not going to worry about this over here because in the 2019 financial statements, we don't have a 2017 column. We only have a 2018 column because most financial statements only show one prior period. IAS 1 says that you can show, you must at least show one prior period. So most companies will just do the bare minimum. So they'll only show one prior period, but you can show more prior periods. Okay, just take note of that. So that is the impact on inventory. Okay. Now, remember what goes hand in hand. This is just one journal entry. Okay, so that is just basically one journal entry. Okay. There's only one part of a journal entry. So now remember what goes hand in hand with inventory. So what always goes hand in hand with inventory is cost of sales. Okay. So there's going to be an impact on cost of sales. Now understand that the formula for cost of sales is as follows. Cost of sales ultimately comes about as follows. Opening inventory plus purchases, if you're a manufacturing company, we call it production, minus closing balance. Okay. So what's happening over here is the following. Okay. So this middle column over here, that represents the impact on profit or loss. Okay, so this middle column represents the impact on profit or loss. That impact is basically cost of sales. Okay, so that impact is basically cost of sales. Okay, so what we're going to do over here, we're just going to say opening balance, current period minus prior period. And I'll show you in terms of the formula how it makes sense. So this middle column over here, this is cost of sales. So let's have a look how we get that 7,600. Okay, for purchases, we don't put anything. Okay, because remember, purchases comes about where we buy stuff from a supplier. So picture Coca-Cola, picture Pick and Pay buying from Coca-Cola. Coca-Cola don't care at all what our inventory accounting policy is. We must pay them based on the invoice. So whether we use WAC, whether we use FIFO, that does not change the invoice amount one bit. Okay, so take note, purchases will not be impacted because purchases is driven by purchases and returns. The supplier does not care which accounting policy you use. So whether you use WAC, whether you use FIFO, that has zero impact on purchases because Coca-Cola wants you to pay them based on the invoice that they have given you, okay, what you agreed upon. So therefore we just put 0 over here because it has zero impact on purchases. So opening balance is 70,000 in 2019. The opening balance for 2019 is 2018, so that is 70,000. The closing balance for 2019 is 2019, so that is 76. Similarly, the closing balance for 2018 is 2018. The opening balance for 2018 would be 2017's closing balance. So if we apply the formula, opening balance plus purchases minus closing balance, there you can see there's a 7,000. Ignore the signs for now. Ignore the signs for now. We'll deal with that just now. We'll explain that just now. But that is basically how we get it. Okay, so that's why I just say one minus the other. That will give you your movement. So this over here is the impact on profit or loss. How does it get impacted on profit or loss? It is through cost of sales. Now let's understand what is happening over here. Here you can see there is a negative. Okay, so what is happening to cost of sales? Okay, so what is happening to cost of sales? Explanation. I think that's spelled correctly. Let's have a look what's happening over here. So what's happening? Okay, so cost of sales is decreasing. Okay. Cost of sales is an expense. Okay. Cost of sales is an expense. Therefore, an expense is decreasing. Okay. A decrease in an expense, okay, increases profit. Okay. So there you can see this here is the impact on profit. What's the impact on profit? A positive 7,600. That's the reasoning. Here you can see cost of sales is decreasing. Now, a decrease in cost of sales is a decrease in an expense. A decrease in an expense increases profit or loss. Okay, so that is the explanation. The same story goes over here. They're in the same direction. So the same story go over here. Okay, so remember, this column is not the impact on cost of sales. This column is the impact on profit or loss. So this profit or loss is driven by cost of sales. Cost of sales is negative, meaning cost of sales has a decrease. A decrease in cost of sales, because cost of sales is an expense, as a decrease in an expense. A decrease in an expense increases profit or loss. Okay, so that's that over there. And we just do the same story over here, same explanation. So very important to understand that. Okay, so you must, when you do a question, you must always ask yourself, what are you adjusting? When you're dealing with profit or loss question, you must always ask, and you have to do adjustments. You need to ask yourself, what am I adjusting? Am I adjusting the income? Am I adjusting the expense? Or am I adjusting profit or loss? This is a common thing in group accounting. So in group accounting, they will ask you to comment on the intercompany journals, right? Either on the expense and income itself, or on profit or loss. So some students don't pick that up. So what do? They memorize. If there's a intercompany sale of inventory, then you must do this to cost of sales, that to cost of sales. But when they look at the solution, they can't understand why they got it wrong, because they didn't pick up what they need to adjust. Are you adjusting cost of sales, or are you adjusting profit or loss? Very, very important. Okay. So just take note of that. Okay, so that is the change. Now we will deal with the impact of tax. So for this question, tax is at 28%. Okay, remember going forward, well, from 1 April, it is 27%. So this it's at 28%. So we'll just say that multiplied by 28%. Okay, so what you need to understand over here. Okay, so as a rule, as a rule, um, what do I want to say now? As a rule, what? As a rule, tax will be in the opposite direction. Okay, so the tax impact will be in the opposite direction. So let's try to make sense of this using so this column over here is balance. This column over here is movement. So a balance has an impact on balance sheet. A movement has an impact on income statement. Okay, so a movement always have impact on income statement, OCI, profit or loss. A balance has an impact on the statement of financial position. Okay, so this here is a statement of financial position, and this over here is balance income statement. So, so this 77,000 Rand is an increase in inventory. Okay, so this here is an increase in inventory. We're trying to understand why do we have a negative amount. So a negative amount would imply for balance sheet a liability. So why do we have a deferred tax liability over there? Okay, so let's understand that. So what you must understand, if we use this over here, so the impact is as follows, okay? The change in accounting policy brings a change of an increase of 77,000 Rand, or 77, I'm just going to say 77, I'm not going to say 77,600, it is 77,600, I'm just going to say 77 for so I can explain easily. So there's an increase in an asset of 77,000. Now remember, what's happening with an asset? An asset, it implies that in future, we expect future economic benefits of 77,000 Rand. So accounting will have an income of 77,000 Rand. And also in future, remember what is an asset? An asset is a glorified expense. An asset is an expense waiting to happen. So in future, we will have an expense of 77,600 Rand. Okay, so therefore, from an accounting perspective, the impact on profit will be 0. In future, from a tax perspective, because accounting have an income of 77,600, SARS will also have an income of 77,600. However, in future, SARS won't have a deduction for this amount, because remember, SARS is not does not apply a change in accounting policy. So therefore, SARS will have no deduction. So in future, SARS will have a tax profit of 77,600. So what are we sitting with? An accounting profit of 0, a tax profit of 77,600 in future. As a result, in future, we will be paying more tax. When you pay more tax in future, that means it is a taxable temporary difference. A taxable temporary difference gives rise to a liability. So that is the explanation. A quick rule, tax is simply in the opposite direction. Okay, I can explain this one over here as well. Same thing over here. The 7,600, it is it caused an increase in profit of 7,600. Therefore, increase in profit means more tax. Okay, more tax. So tax expense is increasing. Tax is an expense. So if an expense is increasing, it reduces profit, and that is the negative. Okay, so basically that's the explanation. But if you want to quickly do a check, I always recommend first try to explain it to yourself why it makes sense using proper theory, then do the check to make sure that it's just in the opposite direction. Okay, so this will be the impact on equity. Okay, so balance, maybe we want to call it. So that will be the impact on equity. That's the impact on the balance sheet, impact on income statement, impact on balance sheet, impact on income statement, impact on balance sheet. Okay, now we need to prepare the note. Okay, so I'm not gonna, you can look at the solution for the wording of the note disclosure and what you need to say. I'm not gonna worry about that. I'm just gonna do the actual note and the numbers. Okay, so remember, when you have to prepare a note, remember, notes appears in the notes to the financial statement. Notes to the financial statement is part of a set of financial statements. So for all financial statements, we start off with three things. Company name, so this is Measure Ltd. We give the name of the statement. It is notes to the annual financial statement. Okay, and we must always give the year or the period. So this is for the year ended. Okay, remember, all financial statements is for the year or for the period ended. Only the balance sheet, only the statement of financial position is as at. Please, I can tell you they penalize you for that. Okay, so make sure you know all notes, all statements, income, notes, cash flow, and equity statement is for the period ended, or in this case, for the year ended. Only the balance sheet, only the statement of financial position is as at, and you give the date. Okay, so for the year ended, I think it was 28 Feb 2019. Okay, so number one, company name. Number two, the name of the statement, and then number three, the period. Okay, now all we're going to do is basically answer the question. So remember, we always have current period, prior period. Please take note when you get your question that it does the prior period, the current period is not always in front and then the prior period. So please make sure that you're looking at the right numbers. So I have seen in my few years of tutoring that people get the right answers, but they get zero because they used this as current period and that as prior period. But in the question, it was prior current. So just make sure you have a look at the columns and you make sure that you're looking that is actually current and that is actually prior. Some papers have it switched around. So even though your principles is 100% correct and your calculations is 100% correct, because you have mixed up opening and closing, they don't care, okay? Because you can't mix that up in the real world. So now there is basically two parts to this thing, okay? So I'm going to highlight this in red because you don't show it in the note, but basically I'm just showing you what you need to think. You need to show the impact on profit, okay? You need to show the impact on profit. So I'm highlighting this in red because you don't show it in the note, okay? It's just for you to understand. And then you want to show the impact on equity, meaning SFP, okay? So the impact over here, you must say increase or decrease. There we can see it is a decrease in cost of sales. So a decrease in cost of sales. The fact there was a decrease in cost of sales in both years, you can just put it decrease. If the 1 year was a decrease, 1 year was an increase, you would have to show if 1 year was a decrease and 1 year was an increase, then you must show decrease, increase. But you will have to tell them that decrease is negative, okay? In this case, we don't have to put decrease in negative because we're only showing one number, Okay, so because only, we both is a decrease. So just take note of that. Okay, so in this case, we will just show decrease. The decrease in cost of sales is simply the 7.6, and it is simply the 7.6 and what was that? The 7.6 and the 13. Okay, so just be aware of that. So because there was a decrease in cost of sales, that resulted in an increase in profit. Okay, so remember, it is the impact on profit. So a decrease in cost of sales increases profit. Please understand that. Okay, it's not the impact on cost of sales, it's the impact on profit. So a decrease in cost of sales increases profit. If it was an increase in cost of sales, that 7.6 would have been a negative number. Okay, very, very important. Then, what other impact do we have? There's an impact increase in current tax, and then there's also an increase in deferred tax. So remember, the deferred tax implication would be for the prior period because SARS did not open up. Okay, SARS did not open up. So because SARS did not open up, there will be a temporary difference between accounting treatment and tax treatment. So therefore, last year's one would be the deferred tax implication. Okay, so remember, there's an increase in deferred tax. So increasing an expense decreases profit. Okay, so just take note of that. Over here, there's an increase in current tax. Remember, in the current year, SARS and accounting will do the same thing. So therefore, it is fine. So this is basically impact on profit. So here you can understand, this is what I was trying to make mention of. You must understand your direction. Okay, you need to understand your direction. It does not mean I see a decrease that I will show a negative, because this note is not this part of the note is not an impact on cost of sales. It is an impact on profit. So a decrease in cost of sales, the impact on profit is positive. An increase in current tax, which is an expense, has a negative impact on profit. So please make sure you understand that. Okay. Then we will have an impact on the balance sheet, or the impact on equity. Okay, so the impact on equity. Okay, so we will have the balance sheet line item. It was inventory. Okay, inventory is changing. And once again, it will be what happened to inventory? There was an increase in inventory. Okay, then there is an increase in current tax payable, and then there will be an increase in the deferred tax liability. Okay. This here is the impact on equity. Okay. Okay. So what happened to inventory? Remember, we use the balances. So we will take the 77,600 over there, it will be the 70,000. Current tax payable in the current year, you will use the 21. So remember, an increase in the current tax payable is an increase in a liability. An increase in an asset is positive, increase in a liability is negative. Similarly, over here, there would be the increase in the deferred tax liability. So just take note of that, okay? Just so you know, the red is just for you to understand what is happening. So you can either say impact on profit, or you can say, because the final number is positive, you will say increase in equity. Okay. Same thing over here, because it's positive, another word to say, or another term you can say, is increase in profit. Okay, both are positive, so that's fine. What you can do, instead of splitting this up over here, instead of splitting that up, so I'm going to highlight this in orange. I'm going to highlight this in orange so that you can see another way of showing it. Another way of showing it would have just simply be increase in income tax. So they would have simply just be the 21, and it doesn't matter, okay? Doesn't matter. It's still giving me the same story, so it's okay. So the orange could either be like how I have it above, or it can be how I have it over here. Okay, same story, so totally fine. So for the orange, it could either be like this, or it could be like that. Does not matter. Okay, so that is basically, that's the note. That's the note to the financial, for the change in accounting policy. So same thing with correction of error. It is just basically showing the impact on profit, showing the impact on equity. Okay, so that's it from my side. Is there any questions your side? Any questions your guys' side? Yes, no? If no, you guys are good to go. I'll just give 2 more minutes. So for those who wanted, who never joined previously, one of the previous, you just WhatsApp me on that number. Yeah, you can just WhatsApp me on that number. How it affected deferred tax, what affected deferred tax. For the prior year, how it impacted deferred tax is as follows. They told you that SARS did not reopen the prior periods. Because SARS did not open the prior periods, current tax of prior periods will not change. So therefore, there will be a difference between tax treatments. As a result, that has an impact on deferred tax.
Okay, guys.
Hi. Hello.
Yes. Also, a question.
There is a question here. Luvuani asked, and I also have the same question. It says that kindly tell us if SARS will, what happens when SARS reopens the previous
So
year.
it goes against current tax, not deferred tax. There'll still be an impact on tax because the number of profits are changing, but because prior period did not open, the impact on tax goes to deferred tax. If SARS did open prior period, then the tax impact would go against current tax.
Basically, would still have the same calculations, but then
Correct.
instead of deferred tax, would have income tax.
Correct.
Okay, thank you.
Okay, guys, I think that's it on my side. I'll probably see you guys next week. I'll let you know, but most likely. So we most likely do a Mac question and not. I think we're done with fact now. Okay. Okay. Bye bye.